Hi there. Exciting news for all of you home buyers and homeowners. The Bank of Canada's overnight rate has just dropped by 25 basis points or 0.25%, which is the third drop in a row. So whether you're thinking about buying your first home, moving up or refinancing, this little dip could mean big savings for you. In today's video, I'm going to break down what this rate drop means for your wallet and how you can make the most of it, and a forecast of what I think is going to happen in the next while. You may be asking yourself, interest rates are decreasing, what should I do now? I'm going to provide some analysis to help you determine whether now is the best time to buy or sell, or if you should wait. So let's dive in. A bit of history. After 10 overnight rate increases since January 2022, the Bank of Canada in the last 3 rate announcements has decreased the overnight bank rate by 25 basis points, that's 0.25% each time. In their current notes, the Bank of Canada said that growth in the Canadian economy was slightly stronger than expected in the second quarter, but showed signs of softer activity through the summer. Inflation is evolving largely as expected, and the bank judges the economy to be in excess supply, which should put further downward pressure on price growth. The trends to watch this fall are the state of the Canadian labour market and whether inflation is following the Bank of Canada's forecasts. As long as price growth is within expectations and employment is not significantly weaker, we are expecting rate cuts over the next months of 25 basis points until the bank reaches its neutral range between 2.25 and 3.25% in 2025. So, what does all this mumbo jumbo mean? Well, it actually really means good news for both home buyers and home sellers. Let me break this out for you. Since the Bank of Canada overnight rate increases after May 2022 from 1% to 5%, and with prime rate as high as 7.2%, the sales of homes has plummeted. New buyers and existing mortgage holders have been obtaining and renewing mortgages at over 6%. As well, new mortgages have to be qualified at over 8% with the 2% stress test added by the federal government. We have not seen these rates in decades. Over years 2020 to 2022 during COVID, sellers watched a highly active market with multiple offers and rates increasing every day. Sellers are now in shock to realize that they have missed their selling opportunity. Stubbornly, the sellers refusing to reduce their list prices, buyers have just decided to stay home and not enter into buying, hoping that the rate increases were temporary and would come down soon. However, some sellers just have to sell and have had to reduce their selling prices to make the deals happen. This has pulled the single-family home prices down 10% or more, but not as much as expected. Now, 2 years later, with no changes until June, with the first rate decrease, the market has stalled with a much larger inventory, slight decreases in list prices, and low activity. I think buyers just want to have some confidence that they're getting the best rate, and many have instead decided to improve their current homes instead of that move up or just waiting to see what will happen. So how do we decide if this is the right time to jump into the market? Should buyers sit it out and wait to see how low the mortgage rates will go? Or should they jump in the market and buy now while the house list prices and hungry sellers are perhaps the lowest they will be? We don't know yet if we're at the bottom of the price drop in home prices, but as interest rates drop and the demand increases, you can bet that prices will start again to creep upwards. It is simply the law of supply and demand. Low supply, high demand equals maximum prices. This is the perfect scenario for sellers, but not buyers. Can buyers time this market to get the best value? Will seller prices continue to lower, and should they sell now or wait until the market heats up again with higher selling prices? As I said in my previous video number 92, will the mortgage rates go down in 2024 in Canada? My predictions. It might be a good time to get off the fence and look at the buying now before prices increase again. On the aside, I did a 45-year of price drops in Greater Victoria, there being 8 major drops in selling price averages. In every case within 2 years, the average selling price was greater than before the price drop. I'm not able to say that this will happen again, but because we live in a very desirable area and there are migration pressures and demand to live here, I do believe this is quite possible. Let's look at an example and do the cost analysis. I'm using semi-annual compounding interest in my analysis, so it might be a little different with your banks because of the way they compound the interest, but this is close enough to demonstrate the analysis. I will also use a 25-year amortization period. In August 2024, the single-family home average price in Greater Victoria was $1,274,983 versus a year ago of $1,315,856, which is about 6.5% less than a year ago. So let's round this to $1,275,000. If you were to purchase this home now with 25% down, which is $318,750, and had a mortgage of $956,250, a 0.25% interest rate decrease would save you over the first year an average of about $193.84 per month, or $2,325.72 per year. Current 5-year fixed term rates at the time of this video in September 2024 at the Royal Bank can be found at 4.84%, and I've seen special rates as low as 4.4%. A number of Canadian economists are projecting that the mortgage rates will go down to between 2.25 and 3% by the end of 2025 or early 2026. Let's suppose we see a further rate decrease of about 1.75% over the next year to 3%. If we wait until then and then pay the price for the single-family home at $1,275,000, which is the August average price, then we could save about $1,350 interest costs per month, or about $16,200 per year. If you decide to wait 1 year and the mortgage interest rate comes down a full 1.75% and the average cost of houses do not increase, then you might save around $16,000 by waiting. If you waited 2 years and the interest rate stayed around 3%, which is expected, and the average buying price did not change, which I believe will increase, then you might save up to $32,000. However, when interest rates fall, sales increase, and this drives up prices. If house prices increase to only 2%, then the cost of waiting and buying might mean an additional $25,000 each year on this particular mortgage. If we see an average price increase like between 2016 and 2022, with increases as high as 15% a year, then the future cost of purchasing could be a very large increase in the hundreds of thousands of dollars. Also, you have to consider that once you are ready to purchase, will you find the perfect home you want, and will it be the average price or a premium price to purchase? And also, you have to consider that you will have missed living in that nice new dream home for a year or two. This is good advice from past realtor and my wife Rosemary. She said, smart buyers buy when it's best for them, not when it's best for the sellers. If you buy when there's no competition like now, your offer will generally get accepted. If during the hot market, for example in the spring, or with lower interest rates, you have a lot more buyers in the market, and you will end up paying a higher price due to multiple offer competition. Now, no one can predict what will happen, we can only guess. So what we need to do is have a strategy to try to mitigate the purchase cost. One strategy could be to purchase your home now when the prices are down a bit and lock into a 2 or 3 year fixed term. As we expect rates to fall, then when the term expires, renew for a 5-year fixed term with a lower rate. You will have fixed the purchase price at today's deal prices and can expect a lower mortgage interest rate in the future. Once sales start to pick up, and they will, as the inventory lowers, it will cause the price of homes to increase. Scarcity and the fear of missing out will drive people to again pay more for properties. However, you will not be in that situation already having made your purchase when prices were lower. Here are a couple of extra tips if you plan to buy now before the next Bank of Canada overnight rate announcements. First, get your rate guarantee in place with your mortgage provider. If you purchase soon, then negotiate the closing date to be after the next or the next 2 Bank of Canada announcements. If the rate comes down, you will get that rate, and if not, your rate guarantee will give you the current best rate negotiated with your mortgage provider. Even if you sign your mortgage papers just before the rate drop, many banks will give you the lower rate if it's not too far from the closing date. If you are considering purchasing a pre-build or a new construction property, a number of them have worked to rate guarantee deals with mortgage providers that will allow a rate hold up until the closing date, even if it's more than 120 days, possibly even up to 2 years. In many cases, they are also providing moving in amounts such as no strata fees for the first year and other concessions to get you to commit to a purchase. It is often worth having a look at these. I did not get to talk about how the Bank of Canada overnight and mortgage rates affect sellers. I will discuss this fully in a future video, so stay tuned. And finally, here's my prediction on the next few Bank of Canada overnight rate announcements. I have been correct on the last three, having predicted the lowering in each case. I thought September might drop 50 basis points, but it only dropped 25 basis points, but I still hit the right direction. I think there will be 2 more rate drops this year. October 11th, we will see a 50 basis point drop, and on December 11th, we will see a 25 basis point drop. If I get both of these right, then I'm going to go right out and buy a lottery ticket, so wish me luck. Anyway, thanks for watching, and I'll see you next time.